In the late 19th century, Charles Dow sought a way to quantify the performance of the booming railroad industry and pioneered the Dow Transportation Index. It quickly became a reflection of the American economy, and indices have evolved to provide exposure to entire economies. They serve as the foundation for a variety of financial instruments, including index options, enabling you to gauge and gain exposure to a large variety of markets. You might be familiar with some of the most popular indices that track the broader equity markets, such as the S&P 500, the Nasdaq, and the Russell 2000. Financial products are listed to track these indices, including ETFs, futures contracts, and index options. Index options are derivative contracts based directly on these indices, offering the right to buy or sell the value of an index at a predetermined price on a specific date. Let's explore the primary differences between an index option and an equity or ETF option. Let's start with the options contract. Options come in two types, American and European. American options can be exercised at any time on or before the expiration date, while European options can only be exercised on the expiration date. Most stock and ETF options are American style, while index options are typically European style. Additionally, unlike equity or ETF options, index options are typically cash settled at expiration, meaning your trades will settle in cash rather than with actual securities. The amount reflects the difference between the strike price and the index's value at expiration. These features make managing index options around expiration simpler by removing early assignment and exercise risk. Lastly, index options come in both AM and PM settlement contracts. Equity and ETF options are PM settled, meaning they're settled based on the closing price on the day of expiration. However, AM settled index options are settled based on the opening price on the day of expiration. This adds a level of complexity, since you take on overnight risk with an options contract that ceases trading the day before expiration, but is not settled until the opening price of the following day. Now that we have a better understanding of index options contracts, let's explore what trading index options entails. Index options are typically listed on some of the world's most widely tracked indices, with billions of dollars in notional value traded per day. One benefit of this is the wide variety of expiration dates and strike prices that are typically listed for an index option. Many popular indices, such as SPX and NDX, now have daily expirations, with hundreds of strike prices to choose from in each expiration, providing you with the ability to trade almost any point on the volatility surface. The S&P 500 offers the most strikes, with nearly 18,000 strikes listed and expirations stretching until 2033. Nasdaq offers nearly 11,000 strikes, with expirations until 2026. Even the Russell 2000 has over 5,000 listed strikes, with expirations until 2029. This flexibility has turned index options into some of the most liquid options contracts traded on listed exchanges. However, most of today's popular index options were listed decades ago when index values were significantly lower. This has resulted in many index options having notional contract values in the hundreds or thousands, or even over $1 million, making them generally suitable only for large retail investors or institutional traders. To address this, in recent years, there has been an increase in the listing of mini index options that provide a smaller notional value relative to full-sized index options. However, these typically do not have the same level of liquidity or strike selection as full-sized index options. Examples include XSP and Nanos for the S&P 500, and NQX and XND for the Nasdaq. Let's look at an example of a simple index option trade. If you anticipate that an index will increase in value, buying a call option could be a suitable strategy. For example, assume an index is currently valued at $150, and you believe it will rise in the coming months. You might consider buying an at-the-money index call option with a $150 strike price that expires in 60 days. If the premium for this call option is $4 or $400 per contract, that amount represents your maximum risk. The break-even price would be $154, which is the $150 strike price plus the $4 premium. If the index rises to $160 at expiration, the call option would be in the money by $10. The intrinsic value would be $1,000, calculated as $10 times 100, resulting in a profit of $600 after subtracting the $400 premium, excluding any fees or commissions. If you do not close the position early, this profit would be deposited in cash into your account at expiration. To understand how an index option behaves at expiration, consider 3 scenarios. If the index drops to $140, the call option expires worthless, and you lose the premium paid, while the put option would be in the money by $10, resulting in $1,000 deposited in cash. If the index closes exactly at $150, both the call and put options expire at the money and are essentially worthless. If the index rises to $160, the call option would be in the money by $10, resulting in $1,000 deposited in cash, while the put option would expire worthless. In an ever-evolving financial market landscape, index options encapsulate broad market sentiment and offer an efficient way to gain exposure to market direction through a single liquid product. Index options represent an effective method for navigating trends in the broader financial markets. Visit bmo.com/online investing to get started.